You know, every single day, something like 10,000 baby boomers turn 65.
Yeah, it's a staggering number.
It really is. I mean, it's arguably the most predictable, just unstoppable economic ways in human history.
Absolutely.
And today we're looking at a newly public company that, well, they claim to have built the perfect surfboard to catch that wave.
Right, Janus Living.
Exactly. I mean, this is a company sitting on $1 billion in cash, carrying exactly zero debt, and boasting a narrative that Wall Street has just absolutely fallen in love with.
They really have.
But there is this fatal vulnerability that we need to talk about.
Yeah.
Because they don't actually know how to run the business they're buying.
Yeah, and that's the irony of Janus Living, right? You have investors pouring capital into it to capture this massive healthcare trend.
Right.
But the company's legal structure essentially forbids them from practicing healthcare. They are legally walled off from the very demographic trend they're, selling to the market.
It's wild. So welcome to the deep dive, everyone. For those of you listening, think of this as a masterclass in how to analyze a newly public company when the hype of a macroeconomic trend just collides headfirst with the gritty reality of actual business execution.
A great case study.
We are focusing entirely on Janus Living today. As of right now, August 4th, 2026, they are the market's only pure-play senior housing real estate investment trust, or REIT, as we usually call it.
Yeah, the only pure play out there right now.
And the stock has been on an absolute tear since its IPO back in March. We're talking a 28% year-to-date run. I mean, people are just aggressively buying this story.
They are, and I mean, the story is highly compelling. But let's ground that initial post-IPO euphoria for just a second.
Okay, let's do it.
Because while that year-to-date run is really impressive, the stock actually just suffered a 5-day pullback of about 4.4%.
Right.
It's currently sitting at $29.55. And what we're seeing here is that initial surge of demographic excitement starting to, meet the gravitational pull of the actual market.
Right, because a brilliant macroeconomic thesis doesn't automatically mean it's a profitable investment.
Exactly, especially if the entry price is wrong or, if the operational execution starts to falter.
Okay, let's unpack this. Because when you look at the Q1 2026 financial realities, I mean, the top-line numbers look like a rocket ship.
There are definitely big numbers.
Q1 was massive. They reported $200 million in consolidated revenues, which is a 35% year-over-year increase.
Mm-hmm.
And their adjusted EBITDA. And we'll definitely get into what that actually means in a second. But that was $65 million, up 42%.
Right.
Plus same-store adjusted net operating income, or NOI, that jumped 13.8%. I mean, those are just monster growth numbers for real estate.
They are substantial, for sure, but let's clarify that metric you just mentioned, the adjusted EBITDA.
Yeah, please do.
So at the end of that, it stands for real estate. It's this customized metric that strips out the massive depreciation charges that just naturally occur when you own a ton of physical buildings.
Right, because buildings age and lose value on paper.
Exactly. So it gives a clearer picture of operating profitability. But even with that strong operational growth, the valuation the market has assigned to Janus Living is just incredibly steep.
Oh, it's wild.
At that $29.55 share price, the company is trading at roughly 31 times its 2026 funds from operations guidance midpoint, which is 95 cents.
31 times. I mean, that is a massive premium for a senior housing REIT in its very first year as a public entity.
It's pricing in a lot of perfection.
And this is the part of the income statement that just makes me want to pull my hair out, honestly.
The margins.
Yes, they have 35% revenue growth, right?
Yeah.
But their trailing 12-month earnings per share is actually negative. It's minus 2.7 cents.
Yeah.
And their net margin, it is a microscopic 0.39%. I mean, how does a company with $200 million in quarterly revenue have a net margin of basically zero?
Well, it sounds bad, but what's fascinating here is that the underlying business isn't necessarily broken.
Hi.
What you're looking at is a classic early-stage platform drag.
Platform drag, okay.
Yeah, those low margins you're seeing are heavily weighed down by formation-related costs from their recent IPO.
Right.
Think about what happens when a company goes public and rapidly acquires dozens of massive properties. You have astronomical legal fees, title transfer taxes, severances for the previous operator's staff.
Complete rebranding initiatives, I'm sure.
Exactly. These are massive one-time accounting drags that just obliterate traditional net income for the quarter.
So it's kind of like opening a massive hit restaurant where the line is completely out the door.
Right.
But you spent so much on the grand opening and hiring all the kitchen staff that you only make 39 cents on a $100 meal.
That is exactly what's happening. So all that cash went out the door to essentially build the corporate plumbing, which makes the bottom line look terrible right now, but it doesn't necessarily mean the nursing homes themselves are bleeding money.
Okay, that makes sense.
And in the REIT world, traditional net income is heavily distorted by those one-time transactional costs, plus, like we mentioned, the required depreciation of the buildings.
Right, the on-paper losses.
Yeah. That's why REIT investors mostly ignore traditional EPS and focus on funds from operations, or FFO.
Got it.
FFO adds back that depreciation and strips out those one-time sales metrics to show you the actual recurring cash generated by the properties. And on that metric, Janus Living generated 23 cents per share in Q1. So the cash engine is indeed functioning.
Okay, I follow you on the accounting. The cash is flowing.
Right.
But even if it's due to transition costs, when your net margins are 0.39% on paper, your margin for error in the real world is just incredibly thin.
Oh, razor thin.
Right. Any operational misstep is going to be magnified immediately. Which kind of brings us to how they are actually funding all this massive growth.
Yeah.
Because they are just buying up everything in sight.
They are on a spending spree for sure.
And this is where Janus Living's balance sheet comes into play. For a newly public REIT, it is basically a financial fortress. As of March 2026, they had $949 million in unrestricted cash.
And exactly zero outstanding debt.
Zero.
Which, in the heavily levered world of commercial real estate, is almost entirely unheard of.
Yeah, they essentially went public, scooped up a massive pile of equity from investors, and haven't touched a traditional mortgage yet. Their total liquidity sits at $1.5 billion.
That's a lot of dry powder.
It is. That includes the cash, an undrawn $500 million revolving credit facility, and a $100 million delayed draw term loan.
And that delayed draw term loan, that's a vital piece of context here.
How so?
Well, unlike a traditional loan where you borrow the money and start paying interest on the full amount on day one, a delayed draw facility gives a company a locked-in interest rate and a guaranteed pool of capital.
Okay.
But they don't actually pull the cash down, and they don't pay the bulk of the interest on it until the exact day they close on a new property.
Oh, wow. So they just have it sitting there waiting.
Exactly. It is a massive structural advantage for a company trying to move as fast as they are.
And they're moving aggressively. I mean, they deployed $714 million into senior housing acquisitions before the IPO even happened.
Right.
Then they executed a $314 million joint venture buyout for 19 separate communities. Then another $400 million acquisition closed in March.
Yep.
And right now, they have another $400 million pipeline targeted for Q2 closings.
Yeah.
Why the frantic pace?
Because right now, they're acting as a pure capital aggregator. With no debt and $1 billion in cash, they can just completely outmaneuver their competitors who are currently paralyzed by higher interest rates.
Right. Everyone else is squeezed.
Exactly. But having the capital to buy a building doesn't mean you have the capability to run it.
Okay, here's where it gets really interesting. Because Janus Living doesn't run a single one of these communities.
Not one.
Wall Street loves calling them a pure play senior housing REIT, but the reality of that label means they have a very limited durable moat. By law, to maintain their tax-advantaged REIT status, they cannot provide the healthcare services themselves.
Right. They are legally barred from it.
So they rely entirely on third-party operators, management companies like Pegasus Senior Living and Seal Senior Living. They handle the day-to-day reality of running these facilities.
Yep.
So if Janus doesn't run the facilities, aren't they basically just a landlord completely at the mercy of their tenants' management skills?
That is the defining vulnerability of this entire investment thesis. Yes, they are just a landlord.
Wow.
And in the senior housing sector, there are very low barriers to entry. Anyone with enough capital can build a facility.
Sure.
The only real differentiator is operator execution. Can the staff keep the residents healthy and safe? Can they manage complex dietary requirements? Can they maintain high occupancy while keeping labor costs under control?
Right.
Janus Living is entirely dependent on third parties to execute that flawlessly while they just sit back and collect the rent.
Okay, so let's look at the actual track record of the properties they're buying. That $314 million joint venture buyout for those 19 communities.
Right, the big one.
Yeah, As of March 2026, the occupancy rate across that entire portfolio was just 80%.
Yep.
1 out of every 5 rooms is sitting empty, generating absolutely zero revenue. But wait, let me push back on this a bit.
Go ahead.
Isn't 80% occupancy exactly why you buy a portfolio like this?
How do you mean?
Well, you buy an underperforming asset with your massive pile of cash, you bring in better management like Pegasus or Seal, you fill those empty beds, and you capture the upside. Isn't that just textbook smart real estate investing?
In theory, yes. The business plan is absolutely to buy undermanaged assets and optimize them.
Right.
Janus is projecting that upon stabilization, these properties will hit 7.5% to 8.5% cash NOI yields.
Which means for every $100 they spent buying the property, they expect it to generate up to $8.50 in pure operating cash flow every year.
Exactly. But that is an unproven forward-looking projection. You really have to consider the structural limitations of how you actually take a property from 80% to 90% occupancy.
Okay.
It is not like an apartment building where you just lower the rent slightly and hand someone a key.
Right, because this is healthcare.
Exactly. Senior housing is a highly regulated healthcare service. Getting qualified nursing and care staff is arguably the biggest bottleneck in the entire industry right now.
The labor shortage.
Yes. State laws mandate very specific staff-to-resident ratios. If a facility does not have enough registered nurses or certified nursing assistants on shift, state regulations physically bar them from admitting new residents.
Wait, really? Even if they have the physical beds?
Even if the beds are empty, you could have a line of aging baby boomers wrapping around the block, waving their checkbooks. But if Pegasus or Seal cannot hire and retain enough nurses in a tight labor market, those rooms stay empty.
Wow. That completely flips the script. The demographic demand isn't the constraint here. The labor supply is the throttle.
Precisely.
And we already established their net margins are microscopic right now. So if Pegasus has to suddenly offer massive signing bonuses or higher hourly wages just to get the nurses required to fill those empty beds,
Yep.
those increased labor costs going to eat directly into whatever profit Janus Living was hoping to capture.
The labor market is the ultimate variable here. Janus is asking the market to trust that these third-party managers can take an underperforming 80% occupied portfolio and somehow optimize it without letting wage inflation destroy the bottom line.
Man. So if you put yourself in the shoes of an investor today, you have to reconcile this incredible tension. And you see it playing out in how Wall Street is pricing the stock right now. There's a serious sentiment tug-of-war happening.
Oh, definitely.
On the bullish side, the narrative is incredibly strong. You have major players like Wells Fargo and Barclays, both maintaining overweight ratings on the stock.
Right.
They both have a $33 price target on it, which implies about a 12% upside from where we sit today.
Yep.
Seeking Alpha recently published this glowing piece highlighting Janus as the ultimate pure play on senior housing growth. And they also recently declared a monthly dividend of roughly 4.7 cents per share, which gives you about a 1.9% annual yield.
Right. And that dividend is attractive for retail investors looking for steady income. But you really have to look at the payout ratio.
Okay.
Based on their projected FFO earnings, that dividend represents a 60% payout ratio, meaning 60 cents of every dollar of cash flow they generate is going straight back to shareholders.
Which leaves only 40% to reinvest in the business, or, more importantly, to act as a buffer if these operator transitions get messy.
Exactly.
That does not leave a lot of breathing room for growth or error.
Yeah.
And that is where the bearish sentiment comes in. Stock was just flagged by Benzinga alongside a few other REITs for having high RSI values.
The relative strength index.
Right. For those who don't watch technical charts all day, RSI measures the speed and change of price movements. When it flashes high like this, it indicates the stock might be overbought.
Right. It means the hype, the demographic story we talked about has outpaced the actual underlying buying power. The momentum is just stretched.
And fundamental analysts are seeing the exact same stretch. There is a very detailed Seeking Alpha Bear report arguing that at 31 times FFO, the current valuation already fully prices in any near-term upside.
And we should mention their price-book ratio is an elevated 4.02x.
Wow. Okay, to put that in perspective for you listening, investors right now are willing to pay $4 for every $1 of actual brick-and-mortar real estate Janus owns on its balance sheet.
It's a massive premium for a company that just went public.
It really is.
Yeah.
Paying 31 times FFO for a REIT that relies entirely on third-party operators is like Well, it's like buying a Formula One car for top dollar, but the
Yeah.
rules say you aren't allowed to drive it yourself.
Right.
So you're just hoping the guy you hired off the street knows how to use the clutch.
That is a great analogy. If we connect this to the bigger picture, what the market is doing right now is pricing Janus Living for absolute perfection.
Perfection, yeah.
When you trade at over 4 times your book value, investors aren't just paying for the assets you own today. They are paying for flawless execution of your future pipeline.
Yeah.
They're paying for that 80% occupancy to magically become 90% occupancy tomorrow without any labor cost blowouts.
And let's look at those analyst targets again. Wells Fargo and Barclays say buy with a target of $33.
Yeah.
The stock is currently at $29.55.
Right.
That 12% upside offers zero margin of safety. I mean, if anything goes wrong, if an operator transition fumbles, if an acquisition gets delayed, if nurses go on strike, that 12% premium evaporates instantly.
Which brings us to the immediate horizon, because investors aren't going to have to wait long to see if Janus can actually drive that Formula One car.
Right, Q2 earnings.
Exactly. The Q2 2026 earnings report is expected right now in early August. This is the ultimate prove-it moment. The honeymoon phase of the IPO is officially over. Now, they have to show the math.
So let's break down exactly what the market is looking for in this upcoming Q2 earnings report. Catalyst number 1, the acquisitions.
Yep.
They guided that they had a $400 million pipeline targeted for Q2 closings. The market needs to see that those deals actually closed. But more importantly, did they close at those targeted 7.5 to 8.5% net operating income yields?
That's the key.
If Janus used their massive pile of cash to overpay for mediocre assets just to show top-line growth, that is a massive red flag.
The yield is everything. It proves discipline.
Right.
And catalyst number 2 is the operator transitions.
Yeah.
We mentioned Pegasus and Seal taking over that 19-property joint venture. The market needs to see sequential occupancy gains there.
Because we know they were at 80% in March.
Exactly. Investors are going to want to see that number moving up, ideally crossing the 82% threshold in this report. If occupancy is flat, or worse, if it dropped during the transition because of staffing issues,
Oh, that'd be bad.
the market will severely question their ability to execute this platform strategy.
And catalyst number 3 is something entirely outside of Janus Living's control, the macro environment. Specifically, interest rate policy and the broader narrative around REIT recoveries.
Yeah, that's huge.
Because REITs, even ones with zero debt like Janus, are incredibly sensitive to the 10-year Treasury yield. When the risk-free rate on a government bond goes up, the 1.9% dividend yield that Janus offers suddenly looks a lot less attractive to income investors.
It really does. So the overall stance from the data we have right now is incredibly neutral. You have exceptional demographics and a pristine balance sheet, perfectly counterweighted by execution risk and a stretched valuation.
Right.
The premium absolutely requires operational proof in this upcoming report.
So what does this all mean? If I'm looking at this whole picture, it boils down to one simple dynamic for me. They have a mountain of cash and a phenomenal macroeconomic story.
Unbeatable story.
They are surfing the biggest wave in the economy right now. But Q2 is where we find out if they actually know how to run the empire they just bought, or if they're just throwing money at third parties and hoping for the best.
And this raises an important question to leave you with.
Let's hear it.
Even if Janus Living executes their strategy perfectly, they are still swimming against intense structural headwinds. As you watch this space develop, consider this. The demographic tailwind, the aging of the baby boomer generation, is a near absolute certainty in the coming decades.
Right. It is going to happen.
It's unstoppable. But if a company like Janus Living has virtually non-existent operating moats and relies entirely on third parties to manage the complex, messy human element of healthcare staffing, you really have to ask yourself, are investors currently paying a massive premium for the company's actual business model and execution?
Wow.
Or are they just blindly paying a premium for the demographic wave itself, hoping the company doesn't drown in it?
That is the multi-million-dollar question. A pristine balance sheet really doesn't mean much if you can't actually staff the building. Thank you for joining us on this deep dive into Janus Living. As always, don't just take the narrative at face value. Keep digging, keep questioning the mechanics behind the numbers, and we will be right here to help you unpack the next one.